A bear market is a period characterized by declining stock prices, typically defined as a drop of 20% or more from recent highs, and is often accompanied by widespread pessimism and negative investor sentiment. Understanding bear markets is crucial for investors, economists, and policymakers as they navigate the challenges of economic downturns and seek to mitigate potential losses. This comprehensive analysis explores the characteristics, causes, historical examples, and strategies for surviving bear markets, offering insights into how these periods impact both individual investors and the broader economy. Characteristics of a bear market. Bear markets are marked by prolonged declines in stock prices, often lasting several months or even years. During these periods, investor confidence wanes, leading to increased selling pressure and reduced market liquidity. The atmosphere is typically one of fear and uncertainty, with investors concerned about the potential for further losses. Key characteristics of bear markets include increased volatility, as prices fluctuate more dramatically in response to economic news and investor sentiment. Trading volumes may also rise as investors rush to sell off assets, contributing to the downward momentum. In a bear market, defensive sectors such as utilities and consumer staples often outperform, as investors seek refuge in stocks perceived as more stable and less sensitive to economic cycles. Causes of bear markets. Several factors can trigger a bear market, often involving a combination of economic, financial, and geopolitical influences. Economic recessions are a common catalyst, as declining GDP, rising unemployment, and reduced consumer spending erode corporate profits and investor confidence. In such environments, stock prices often fall as investors anticipate lower earnings and reduced growth prospects. Monetary policy can also play a role in the onset of bear markets. Central banks may raise interest rates to combat inflation, increasing borrowing costs and reducing consumer and business spending. Higher interest rates can also make fixed-income investments more attractive relative to equities, leading to a shift in asset allocation and further pressure on stock prices. Financial crises, such as the collapse of major financial institutions or the bursting of asset bubbles, can precipitate bear markets by undermining confidence in the financial system. These events can lead to credit crunches, reduced liquidity, and widespread panic selling, exacerbating market declines. Geopolitical tensions, such as wars, trade disputes, or political instability, can also contribute to bear markets by creating uncertainty and disrupting global trade and economic activity. Investors may become risk-averse in response to such events, leading to reduced investment and falling stock prices. Historical examples of bear markets. The history of financial markets includes several notable bear markets, each with unique causes and consequences. The Great Depression, which began with the Wall Street crash of 1929, is one of the most severe bear markets in history. Triggered by speculative excesses and economic imbalances, this period saw a dramatic decline in stock prices and widespread economic hardship. The bear market of the 1970s was driven by stagflation, a combination of high inflation and stagnant economic growth. The OPEC oil embargo and rising energy prices contributed to economic malaise, leading to a prolonged period of declining stock prices. More recently, the global financial crisis of 2008 resulted in a severe bear market as the collapse of major financial institutions and the housing market led to a worldwide economic downturn. This period was characterized by extreme volatility, massive government intervention, and significant declines in stock prices across all major indices. The COVID-19 pandemic in 2020 also triggered a brief but intense bear market as global lockdowns and economic disruptions led to a sharp decline in stock prices. The rapid policy response, including fiscal stimulus and monetary easing, helped stabilize markets and contributed to a swift recovery. Strategies for surviving bear markets. Navigating bear markets requires a disciplined approach and a focus on risk management. Investors can employ several strategies to protect their portfolios and capitalize on potential opportunities during these challenging periods. 1. Diversification. A well-diversified portfolio can help mitigate the impact of a bear market by spreading risk across different asset classes, sectors, and geographic regions. By including a mix of equities, bonds, and alternative investments, investors can reduce exposure to market volatility and preserve capital. 2. Defensive investing. During a bear market, investors may shift their focus to defensive sectors such as utilities, healthcare, and consumer staples, which tend to be less sensitive to economic cycles. These sectors often provide more stable returns and can help cushion against losses. 3. Value investing. Bear markets can create opportunities for value investors to purchase high-quality stocks at discounted prices. By focusing on companies with strong fundamentals, solid balance sheets, and competitive advantages, investors can position themselves for long-term gains once the market recovers. 4. Hedging strategies. Investors can use hedging techniques, such as options and futures, to protect against downside risk. These financial instruments can provide insurance against falling prices and help manage portfolio volatility. 5. Maintaining a long-term perspective. It is essential for investors to remain focused on their long-term goals and avoid making impulsive decisions based on short-term market movements. By maintaining a disciplined approach and sticking to a well-defined investment strategy, investors can navigate bear markets with greater confidence. Impact of bear markets on the economy. Bear markets have significant implications for the broader economy, affecting consumer behavior, business investment, and economic growth. Falling stock prices can lead to a wealth effect, where reduced portfolio values cause consumers to cut back on spending, further slowing economic activity. Businesses may also face challenges during bear markets, as declining stock prices can make it more difficult to raise capital and finance expansion. Reduced consumer demand and economic uncertainty can lead to lower corporate profits, layoffs, and reduced investment in research and development. Policymakers often respond to bear markets with monetary and fiscal measures aimed at stabilizing the economy and restoring confidence. Central banks may lower interest rates or engage in quantitative easing to provide liquidity and support financial markets. Governments may implement fiscal stimulus, such as tax cuts or increased public spending, to boost demand and encourage economic recovery. Conclusion. Bear markets represent periods of declining stock prices and economic uncertainty, posing challenges for investors and the broader economy. By understanding the characteristics, causes, and historical examples of bear markets, investors can develop strategies to navigate these periods effectively. While bear markets can create significant financial stress, they also offer opportunities for disciplined investors to capitalize on undervalued assets and position themselves for future success. Through careful planning, risk management, and a long-term perspective,